Good morning, ladies and gentlemen. Thank you very much, Matthew, and thanks to Terrapin for hosting this event and all the sponsors. I'd like to build on yesterday's discussion where Robert smartly took us through a whole range of issues and talk about revenue diversification, a big issue, particularly for the exchanges facing competition. In terms of the different, as a precursor to looking at how to diversify, it's important to look at the competitive structures that exchanges find themselves in. And essentially, there are a couple of models. One is the monopolistic models. So, for example, the emerging markets, many of the countries in Asia and Latin America and in Africa, their exchanges don't face competition today. So in terms of revenue diversification, it's about building up the exchange and developing, perhaps to avoid marginalization of the country and partnering with a range of other exchanges around the world. In terms of North America and Europe, the exchanges find themselves in an oligopolistic competition situation. And this is very similar to a lot of other industries. So, for example, the supermarkets, the petrol stations in Europe, global accountancy practices. And this has a big implication on how to diversify the revenues and also how to change tariffs, etc. Let's look briefly at what this means. So from the key characteristics of an oligopolistic market, and there is a big difference between the exchanges industry and the other sectors that we just looked at, supermarkets, etc., is that, first of all, they need to treat customers fairly. In a number of countries around the world, this is enshrined in law. So you can't have differential charging structures between different sets of customers. It needs to be equal access, equal service, non-discriminatory. Also, what we see in an oligopolistic market is domination by a few suppliers. So if you look in Europe, there are up to 10 key suppliers in each of the different sectors. And therefore, when each exchange provider, or MTF, is trying to introduce competition and innovation, they need to be aware of how their competitors react to this innovation. It's not actually so easy to introduce innovation in this marketplace because the competitors may, i.e. the other exchanges or MTFs, may behave in a different way than the way you expected, and therefore the outcome that you were planning doesn't actually materialize. There are significant entry barriers. We saw how the growth of MTFs happened. There are actually 140 MTFs in Europe. Only half a dozen are successful, and a fewer than that are profitable or significantly profitable. So the entry barriers are very, very significant, and what you'll see and what we're going to discuss today is some of the entry barriers around derivative markets where they really haven't been cracked yet. And if you look at the sort of economic theory around oligopolistic competition, the providers will produce at the point where their marginal cost equals their marginal revenue, i.e. they will sell off marginal capacity to gain more and more volume. But that is quite difficult in an environment where they have to treat customers fairly. So they can't just discount their spare capacity to customers, to their favorite customers. And then the one key problem that exchanges and MTFs face when compared to, say, the supermarket industry or the global accounting practice industry is that their customers are now increasingly their competitors. So you've seen that a lot of the investment banks have set up MTFs, and they internalize as much volume as possible. There was a report last year from the Goethe Institute which showed that how in Europe 40% of the volume is now OTC, and some significant percentage of that could actually be on exchange and doesn't contribute and doesn't receive any contribution to price discovery at this stage. So volume is being increasingly taken away from exchanges or competed for with exchanges, and therefore exchanges face a very difficult situation. So how does in the face of this type of situation, how does an exchange achieve higher market share and improved EBIT? So the key point that exchanges need to understand is where is a service price elastic. Not all their services are price elastic. So for example, if they reduced the tariffs on IPOs, you're not going to see more IPOs. The exchange fee is actually negligible in the context of the total cost of bringing a company to the market. So going through the whole service portfolio, one needs to look at where, in this competitive environment, exchange services are price elastic, and it's not entirely clear. And on the other side, exchanges need to justify how they can charge a fee premium. On their key service, the secondary market service, their fees are roughly between 3 and 7 times higher than MTFs. Also, none of the exchanges provide a rebate on poster fees. So is that a like-for-like comparison? Probably not. It is actually a different product. What you see when exchanges are down, that the MTFs don't actually create price formation to any material amount. So it is a different service, but there is still this comparison by the consumers of the same product, thinking it is actually the same product when it isn't. So getting the message across from exchanges as to why their services should command a fee premium is another big challenge. And in terms of trying to improve EBIT and improve market share, which is the topic we're going to talk about today, there are essentially three key options: tariff reductions, tariff increases, and innovation, customer service, and execution quality. Well, it doesn't, in the terms of tariff reductions, this is unlikely to achieve improved market share and improved EBIT. In any oligopolistic marketplace, a tariff reduction goes straight to the bottom line. You don't see any change in consumer behavior. And that was seen, it's been seen over the last 2 or 3 years. You've seen lots of changes in tariffs, experiments by the LSE and NYSE Euronext in particular, and they haven't achieved sustained market share improvements. So they've just lost out on EBIT. In terms of tariff increases, again, you haven't seen much of this, but if there is a tariff increase, it needs to be justified by improved customer service, innovation, and an ability to identify the value, identify the value with the fee premium. So the key area to focus on for all exchanges is innovation, customer service, and execution quality. This is the way to get market share up and improved EBIT. In terms of looking at the revenue classifications, I'm sure you've all seen this diagram before. It shows profitability against cash flow, and basically what one needs to do is get the products into the top right-hand corner, which are high cash flow and high profitability. If we look at where exchanges were pre-competition, then what you see is that the most profitable product was in the post-trade area associated with CCP services, banking in particular. So where an exchange group was a full vertical silo with banking, like the Deutsche Börse group, they made significant revenues and profits from the post-trade area. And you can see the range of products and how they performed in terms of profitability and cash flow. If you contrast that with the new entrants, with the MTFs, they had one product. They're basically offering secondary market services. And initially, those products were, it was a volume game, and the product was not profitable. But what we saw with Chi-X, once they went above around 15% market share, it started to prove to be profitable. And then now, hopefully with the merger with BATS, they'll reduce the cost base and get a pure economies of scale play. And you should see, based on their normal operating activity, some reasonable profits, particularly given their volumes have grown significantly, assuming you exclude the transaction costs of the merger. But the impact that has had on the traditional exchanges is that there's been significant changes in their existing revenue structures. So you've seen the CCP services have come, the fees associated with CCP services have come down significantly, and it's now basically, just at its bare bones, barely making any money. In terms of the secondary market revenues, the cash markets, so equity markets in particular, they're starting to reduce, but they haven't reduced to the same extent of CCP services. What it's resulted in is new revenues coming in the form of colo services. So a number of the exchanges are making significant revenues now out of colo services. NYSE Euronext is making a huge bet globally on this as to whether their investment of multiple billions of dollars in providing colo services and running data centers is actually going to be the right way forward. And then a couple of other revenue areas. In terms of, because there's now competition, exchanges typically don't provide ISV solutions anymore because that's now provided by independent parties. So the revenue and cash flow and profitability aspects of exchanges has changed quite materially in the last few years, and it will continue to change. The derivative side, as we will hear, is being cracked. There are some new entrants. So if we come back in 1 or 2 years' time, then you should see some changes in terms of secondary market services in the derivative space. You'll see that come down as well. So there's going to be some important issues that we have to address today, particularly on how exchanges are going to make up the holes that this competition is creating in terms of their turnover and EBIT. So I'd like to leave you with one message, and that is essentially turnover is vanity and profit is sanity. So it's important to keep the business profitable, which means it has to be an economies of scale play, much more volume, which was why NYSE Euronext and Deutsche Börse were trying to get together. That would have been a tremendous economies of scale play, but unfortunately it was a monopoly that was being created. With that, I'd like to introduce our keynote speaker for the day. Some of you who were here last year will know him. Patrick Beitel is a partner from McKinsey & Co., and he's going to talk us through battling with decreasing margins in times of volatility. How can you grow your stock exchange business in a flat equities market? So I'd like Patrick to come to the floor. Thank you very much, everyone.